On today's What Do We Do podcast, we're talking taxes. I'm sharing with you the playbook of the rich and how to use taxes as a tool to grow your wealth. It's going to be a great show, so hit the subscribe button, give us a follow, and let's go. This is the tax playbook for the affluent. Keep more, grow more. Hello, everyone out there in YouTube world and podcast nation, and welcome back to another exciting episode of the What Do We Do podcast. Today, we're talking taxes. April 15th is right around the corner. Are you ready? Well, let's face it. If you're affluent, taxes are probably one of your biggest frustrations. But what if I told you that taxes don't have to be the enemy? With the right strategies, they can actually become your greatest wealth building tool. All right, stick with me because today I'm sharing the tax playbook that the wealthy use to keep more of what they earn and grow it. We're going to start first with what I call the mindset shift. Taxes are not bad. Taxes are a tool. Here's the first thing you need to understand. Taxes aren't just an expense. They are, in fact, a tool. The tax code isn't necessarily designed to punish you. It is full of incentives for people who know how to use it. The wealthy don't just pay taxes, they plan around them. They look at the tax code as a guidebook for opportunities, from investing to charitable giving to business growth. It's all in there, and you should check it out too. Number 2, we want to talk about tax diversification. It's not just about investments. Okay, so when you're diversifying your taxes, think about the 3 main categories to discuss. The first are taxable accounts. These include primarily brokerage accounts. Think capital gains and liquidity. These accounts offer flexibility, but they come with capital gains and dividend taxes. Short-term capital gains aren't that great, because you'll typically be taxed at your income rate. However, long-term capital gains can be very helpful, as they max out around only 25%. And also, we could talk about tax harvest losses too. So make sure you know the difference between short-term and long-term capital gains and how and when to consider harvesting your losses too. The next category of account we're going to discuss are tax-deferred accounts. Think 401ks and 403bs. Think IRAs and annuities. You will delay your taxes now, but you will pay them later. For 2025, the basic contribution limits for 401ks and 403bs are up $500 to $23,500. And a catch-up provision remains the same, with the maximum of an additional $7,500 if you're 50 years or older. Also, if your company offers a match, that's free money too. So for your 401k, always consider that in the beginning. And also, let's talk about IRAs. This is a good reminder that if you qualify for an IRA, you can still contribute to 2024 up until April 15th. Yes, you can actually do both your 2024 and your 2025 IRA contributions right now. And to max them out, that would be $7,000 with a catch-up provision of an additional $1,000. Again, please check with your tax professional to make sure you qualify for and understand the tax deductions. The next category would be tax-free accounts, and these are the gold standard. If you leave money in a Roth IRA long enough, that's a tax-free account. So consider your Roth IRAs or municipal bonds or even HSAs and FSAs where your growth and withdrawals are tax-free. Okay, this is the holy grail because of compound interest and no tax obligations upon withdrawal. The Roth IRA use that for growth, and tax-free municipal bonds are for safety and income. Roth IRAs are also available to be contributed up until April 15th for 2024. And they have the same $7,000 plus a $1,000 catch-up. But Roth IRAs do have phase-outs for eligibility. So again, check with your tax professional to see if you qualify. All right, well, how about I give you a hack as well? If you contribute to your 401k or 403b at work, you should have a Roth contribution option. And if so, see if it makes sense for you to use it, because you can instantly add $23,500 or maybe up to $30,500 to your tax-free Roth portfolio. And especially if you don't qualify with the traditional Roth, this is your opportunity. Okay, so what's the contribution and investment strategies between the taxable, tax-deferred, and tax-free accounts? Well, it's basically on a case-by-case basis, but maybe consider the following. Consider starting with the 401k or 403b until you get to the match of your employer. All right, well, now that we've defined those three main account types, what's the contribution and investment strategy between the taxable, tax-deferred, and tax-free accounts that we should deploy? Well, it's really on a case-by-case or person-by-person basis, but let's consider the following. Maybe your 401k or 403b should be your first option until you get to the max of your employer's match. You should do this first because it's free money. After that, then maybe pivot and fully fund your Roth IRA if you qualify. And also consider continuing the Roth option inside of your 401k or 403b too, because that's tax-free growth. And then next, maybe consider a taxable brokerage account for you to invest for success. However, before doing all of this investing, make sure that you have deleted bad debt and that you have 3 to 6 months in a high-yield savings account or money market as an emergency fund. All right, well, I'm in a good mood, so how about another hack? How about this? In taxable accounts and in maybe your loan debt accounts, you might be able to write off either interest or other expenses or depreciation or other costs or fees. So again, please check with your tax planning professional to help you with your specific situation. Well, next up is optimize your charitable giving. I believe that philanthropy is not only about giving back, although that's absolutely the key. It is also a very smart tax strategy for the affluent. Here are several options to consider. First, a donor-advised fund. You can contribute assets, get an immediate tax deduction, and decide later where to give the money. How about charitable trusts? These allow you to donate while keeping an income stream for yourself or your family. And how about gifting appreciated assets? Instead of cash, you could donate stocks or property that has appreciated in value. This lets you avoid capital gains taxes entirely. All right, next up is leveraging your business ownership. And if you're a business owner or real estate investor, you have access to some of the most powerful tax strategies available. You can deduct things like travel expenses, meals, and even your home office. Use depreciation to offset income from real estate investments. You can check out ideas like the Section 179 deduction, or have you heard of the Augusta Rule? And take advantage of retirement plans for business owners too, like solo 401ks or SEP IRAs. You can use these to shield even more income from taxes. As an example, the solo 401k has the same general limits as the traditional 401k, but look into the super catch-up contributions of $11,250 for those that are 60 to 63 years old. Also, the SEP IRA limit is 25% of the employee's total, but up to $70,000. So, as I like to say, the more you know, the further you're going to go. All right, well, we're going to wrap up with one final idea, and that is to partner with the right experts. It's no secret that the ultra wealthy have a team around them. That includes guys like me, their wealth advisor, but also their CPA or tax strategist, as well as their attorney. How come? Well, the tax code is complex, and staying ahead requires expertise. And when you work with a team like ours at Great Lakes Wealth, we don't just look at your investments or taxes in isolation. We look at your entire financial picture to create a tax-efficient strategy that grows your wealth and also preserves your wealth and ultimately passes it on for generations to come. As we like to say around here all the time, if you fail to plan, you plan to fail. All right, well, in closing, here's the bottom line. Taxes aren't just about what you owe. They're about what you can keep. And with the right strategies, you can minimize your tax burden while maximizing your impact and wealth. Well, if you're ready to take control of your investments and start playing the tax game like the pros, then let's talk. You can visit us at greatlakeswealth.us to schedule your free, no obligation consultation. And again, don't go it alone. Find a tax professional to help you thrive in 2025. All right, to wrap up the show, if you found this video helpful, please subscribe to our channel. Hit the like button and share it with someone who needs to hear this. And as always, follow for more. I want to thank you for tuning in today. And as I always say, live your best life, be radically generous, a great big booyah to ya. And this has been another What Do We Do podcast episode, but we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.